Good afternoon, everyone. This is Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today to review the iSectors fourth quarter 2016 performance updates. I will be providing a brief fourth quarter performance overview of all the iSectors models and conclude with a research brief on the markets. This call should last about 10 minutes with questions and answers to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box in the lower right-hand corner of your screen. This presentation will be recorded, and a copy will be available on our website tomorrow at www.isectors.com. Just click on the iSectors blog icon, and it will take you to a link to access the recording. We will also be sending a link to access a recorded copy of this presentation to all webinar attendees immediately after this call. iSectors is pleased to announce the reintroduction of our 15th strategy, the domestic fixed income allocation. As interest rates begin to rise, advisors and their clients need a strategy that attempts to minimize realized losses, earn attractive yields while providing complete liquidity. The domestic fixed income allocation was created to meet these goals. As you see on slide 3, the portfolio consists of 55% investment-grade corporate bonds and 45% high-yield corporate bonds spread over 2,800 issues. The allocation owns these bonds through defined maturity exchange-traded funds laddered from 1 to 5 years of maturity. These funds hold a diversified group of bonds, all maturing in the same year. On a monthly basis, interest earned in the funds are paid to shareholders. On December 31 of the maturity year, the ETF is extinguished and the undistributed principal and interest proceeds are released to shareholders. Since the fund does not trade its securities and all of the bonds mature before the ETF is extinguished, realized losses are minimized. With a current yield of over 3%, you may want to consider this allocation as a core holding in clients' fixed income portfolios. The Post-MPT allocations underperformed their benchmarks in the fourth quarter. Both Post-MPT allocations were negatively impacted by interest rate sensitive securities, especially Treasury bond holdings. Both strategies were helped by financial stock allocations. As you know, and is presented on the chart in slide 4, these sectors moved in response to the early November election results. By the end of the quarter, both strategies have decreased their Treasury bond allocation significantly, with the Post-MPT growth allocation eliminating them altogether. Over one half of the allocation continues to be in energy and utility stocks. The iSectors Post-MPT allocations continue to outpace other ETF strategies. We are pleased that growth is ranked first among all 78 global allocation ETF strategies for 10-year performance in the Morningstar ETF Managed Portfolio database. Investment advisors will be wise to consider Post-MPT growth and moderate allocations as core components for clients' portfolios. The endowment and liquid alternative strategies posted flat results in the quarter. Alternative equity and fixed income funds were strong performers. The strong dollar hurt precious metals and international fixed income holdings. The chart on slide 5 shows one of the equity market neutral funds in black, and that it significantly outperformed a precious metals fund in red throughout the quarter. Both allocations are broadly diversified and will continue to take advantage of the secularly bullish commodity market. Also, it should be noted that the liquid alternatives allocation has outperformed private hedge funds over the past 5 years. Given the advantages of the allocation, including daily liquidity, complete transparency, availability to all clients, not just accredited ones, and a current yield of 2.7%, liquid alternatives should be considered for diversification in case equity returns ease. The global allocations turned in mixed results for the quarter. Domestic equities outperformed global equities, but they both fell behind the Standard & Poor's 500. Both equity allocations benefited from dividend stock holdings, while large cap growth funds detracted from performance. The global fixed income allocation was positively impacted by bank loan and TIPS weightings in the quarter. The allocation was hurt by U.S. mortgage and international corporate holdings. The iSectors domestic equity allocation has earned very attractive returns over the past 5 years compared to most large cap core strategies. In fact, the domestic equities allocation is ranked 12th out of all 563 ETF strategies in the Morningstar database for 5 years performance. The inflation protection and precious metals allocations took a pause from their recent rises during the quarter due to the strong dollar. In 2016, inflation protection was up over 12%, and precious metals rose greater than 11%. As you can see from the chart on slide 7, commodities helped inflation protection allocations results. Gold and silver bullion funds negatively impacted both allocations. We continue to believe that a 10% to 20% allocation to precious metals, inflation protection, and/or liquid alternatives will be worthwhile given our view that the next 5 years in the equity markets will not be as profitable as the last 5 years. The tactical global balance allocation underperformed its 60% stock, 40% bond benchmark in the fourth quarter. As represented by the chart on slide 8, emerging market equities was the leading underperformer for the allocation in the quarter. The rising U.S. dollar also hurt the gold holdings. Broad commodities and U.S. small cap funds enhanced returns. Although the strategy has raised 40% of its portfolio in cash over the past quarter, it continues to be fully invested in commodities and in the commodities and all equity classes. Finally, the chart on slide 9 indicates that capital preservation has earned over 1.8% on an annualized basis over the past 5 years. The yield is attractive with a short duration while maintaining investment grade quality on average. Capital preservation rose during the quarter due to interest rate hedged corporate bond and high yield holdings. 14 of the 15 iSector allocations are fully invested at all times. We believe that generally it's important to be fully invested given the graph presented on slide 10. Over the past 10 years, missing the best 10 days in the market would have virtually wiped out your client's positive returns on a price basis. We have not seen any systematic process, such as the Post-MPT growth strategy, that has bested the Standard & Poor's 500 by 100 basis points on an annualized basis over the past 10 years, that can reallocate portfolios on a daily basis and outperform the S&P. Even if someone created such a strategy on paper, trading costs and taxes would eat up all the profits. Therefore, again, we believe that client portfolios should be fully invested at all times. If you have a client that needs a defensive position, we suggest that you consider the capital preservation allocation. With a duration of 1, even a 1% point increase in short-term interest rates over the next year, which we think is unlikely, will result in only a 1% decline in fund values. This will be more than offset by the 2% yield earned even after fees. The total return received from capital preservation should be significantly higher than that available from money funds. As you carefully inspect the disclosure page, we will now begin the Q&A portion of the webinar. If you have any questions, please type them in the chat box in the lower right-hand corner of your screen. Our first question is, would owning domestic and global equity together make any sense? It really doesn't make much sense because the domestic part of the global equity allocation is the exact same as the domestic equity allocation. It really comes down to the risk that you want to expose your clients. If you wanted the most broad allocation and exposure to the equity market across the world, then the global equity strategy would be the allocation to use. If you're just interested in being exposed to U.S. domiciled companies, then obviously the domestic equity strategy should be used. In both cases, the strategies have a tilt to dividend stocks. All the research and the results from experience show that over time, dividend stocks outperform other stocks. And both strategies have high yielding dividend stocks and growing dividend stocks as a large part of the portfolio. So we think that you should use one or the other depending on the desires of the client. Seeing no more questions, I would like to conclude the webinar by thanking everyone for attending it this afternoon. If there's anything we can do to assist you with your wealth management or 401k asset allocation needs, please let us know. We could be reached directly at area code 800-869-5184. Again, thank you and hope you all have a profitable 2017.